Good afternoon, and welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle.
John, I'm glad to be here with you on another week.
Well, I'm glad you're here too. So as we start this, we know that all 50 states have reopened their economies to varying degrees. And as I mentioned last week, there is a significant divide between those who are eager to get back to work and live without any restrictions versus those who are intensely concerned that reopening too quickly will lead to an even worse second wave. Time will tell. But in the meantime, the Gatewood Wealth Solutions Investment Committee is monitoring the situation closely in terms of how this may impact client portfolios. Now, along with the fear many feel, there is hope given the recent news of potential vaccines and treatments that are in development. While cases are trending down, the virus is still real. We had an acquaintance this week whose parents, both in their 80s, died last week within 5 days of each other because of COVID-19. Yeah, it's a shame, but we know there will continue to be unfortunate casualties since the virus is still with us. But I read a great quote this week. Would you like to hear it?
I would like to hear it.
Fear does not stop death. It stops life. So that's just a great reminder that we can't let the fear keep us from living. And I read one other one.
We should take polls on whether we want to hear it as listeners, but I do.
So worrying does not take away tomorrow's troubles. It takes away today's peace. So for some, I'm sure COVID-19 has changed their behaviors to greater caution, while others will remain unaffected. And it will be interesting to see how quickly people begin to integrate back into their old routines without social distancing. And it kind of reminds me of the fear that was caused by 9/11 when people were concerned for their safety flying airplanes.
Yes,
remember that?
I do.
But that fear subsided to the point where we had record numbers of people flying before this current crisis. So let's hope we get back to that sometime soon. But Aaron, you have a lot of good information to cover today. I did have a sneak preview of your presentation, so I'm excited. Let's get right to it.
Absolutely. So normally we go to our timeline and do a quick review. So the trend for new daily deaths, it continues to slow. That's great. As does the reopening of the economy. The reopening is bringing back economic activity. Now, the recession is deep, but we are likely beginning an ascent from the bottom. So you can see here the information or the data or the new daily deaths. These are real people. It's been sporadic, but that curve continues to decline. And whenever we look at the CDC information, remember more accurate data, but there is a lag. It's still indicating that peak happened in mid-April. Now, when we've looked at these numbers over the last few weeks, April 11th was the highest number. April 18th is now the highest number, but that is still consistent with that mid-April. You would average the two because this is a weekly thing, not a daily tracking or chart. The U.S., as you mentioned, has opened their economy and fears of a second wave are on everyone's mind. There's no doubt about that. And we continue to watch Sweden as that control group for a country that didn't do a lockdown. This week, we decided to compare the U.S., France, and Sweden to see if we could see any material difference in the data. Now, France has been very strict on their lockdown. A lot of people speculate this really has more to do with the political protest with the yellow vests that just continued on for months there. Whether that is the case or not, we do know that they are more restrictive, where you actually have to print off papers saying where you're going. It's time stamped, and they have a system to prevent people from being able to go out. Where Sweden is the most lax, and U.S. is somewhere in the middle, though. There, as you pointed out, there are a large swath of the population that does not take the idea of being in this lockdown, they are certainly protesting. So we don't really see any difference in the data, and this is not a sufficient size to say this is a scientific study by any means. So don't take it other than inference. But I believe there's a lot that we need to yet learn on how viruses actually work, because you would expect some difference here between one that was very restrictive, a middle of the road, and no lockdown. But we don't see that in this data. Once again, a very small sample size whenever we're talking about countries. You mentioned the vaccine. Moderna's reported success in their human trials for the corona vaccine. So this is no longer about testing with monkeys or ferrets, which respond and get the virus as well. These are real humans, and all participants were able to produce those COVID-19 antibodies that they're looking for. And the market rallied significantly on this news on Monday. Now, there are many people that challenged and questioned that data, and the market has since given back that performance, because it does not look as promising as originally announced by the company. Getting to GDP, we saw another drop in the blue chip consensus, and this data is just a general consensus of economists on what they see going forward. So we still have that blue chip consensus moving down, but on a positive note, the New York NowCast, and this uses real-time high-frequency data to try to assess and get the earliest snapshot of what's going on in the GDP. We actually had a positive number here. Now, there's still some detractors, but that does possibly signal a bottom. But I think the jury is still out. We are seeing higher foot traffic. Hotel occupancies, especially around interstates, are increasing. So are gas sales. Now, this is off a very, very deep bottom. So it may see a 20 or 30% increase, but that number is still way below where it was, let's say, a year ago. But it would be reasonable to see economic activity increase as the lockdown is removed, or we go through these phases. So we're hoping that this is signaling a bottom of this deep, what we're now calling a recession. Our investment theme, we've reviewed this many times, and there is no change. We still think inflation risk is high. We still favor equities over fixed income. We prefer the U.S. large cap asset class over the other equity asset classes. And though we are concerned about inflation, we're bearish on commodities, specifically oil, and as well as real estate, because of all the issues, especially in the retail space, as well as concerns about international, which are not so much to do with inflation, just the demographics that they are experiencing, a lot of the political unrest, especially in the European Union. Shape of the recovery. Is this a V-shaped recovery? We continue to say yes, but unfortunately the market has kind of had a pause here around the 2950 mark on the S&P 500. So one of the things that we have been trying to explain and do a better job of explaining is what a V-shaped recovery means. It simply means that you do bottom out and then you move forward and continue up and eventually hit new highs, versus a U-shape, which is that you would stay near that bottom for could be years, or an L shape, which is, yes, you bounce off the bottom, you don't stay near that the low end, but it's a really, really slow ascent, and it takes maybe a decade. So the Great Depression would be an L shape recovery. So yes, the V is kind of spreading out here. Yes, we have this pause in the market at 2950, but it's still technically on track for a V-shaped recovery. Is this pause foreboding? Yes, we think it is, but it does not mean we're going to retest the lows. It's absolutely normal for markets to what is called base, and really what they're doing is testing the current valuation. Now, we know that this is giving a lot of clients some pause, and they're calling in with their concerns. We've all experienced 2000, 2008, 2011, 2018, 2020. And when the market pauses, especially after such a steep sell-off, it's normal to be concerned. And though we do think we could see a pullback, remember we recommended filling the cash buckets last week to get them back up to their target. But we do think a pullback would be temporary, that it would be too risky to try to trade this account. And the Monday rally off just news that there may be a vaccine and how quick that started to move is one of the reasons. You have a 3 or 4% move in a day because you're trying to time the market whenever it's starting to get a little choppy we think is just too risky. Now, with the economic slowdown really has been greater than what we expected, let's say a couple of months ago. I think a fair question is, why are we still optimistic on the market? And it's really the same reason as before. Monetary policy is literally off the charts. The 13-week money supply, non-seasonally adjusted, annualized growth rate, I know that's a mouthful, is 30%. And our listeners and viewers can see that bottom chart where the pink line shows that 30% increase. Now, this chart, the x-axis has actually been changed twice, dealing with how substantial this growth rate is in the money supply. And this money has to go somewhere. It starts in the capital markets. So that's why we've seen such sluggish economic data, but a market that's rallied. As comparison, let's look at the top left-hand chart. And this is the money supply growth in 2008, which was very robust. It was after the recession. The Fed opened up the money spigots, and there was just a record amount of money that was created. It had never been created we haven't created that much money before. Well, until now, because we're actually way ahead of where we were in 2008. Now, the top right shows the growth rate going all the way back to Paul Volcker, or the early 80s. And we can see that we are substantially above anything that we've seen over that time period. We've never seen it this high before. The question then should be, well, is it enough? And, if it's not, we don't, and the market does start to sell off, these two guys here, they're going to continue to pour money in the economy. And these two guys matter. During the weekend, Chairman Powell stated, we're not out of ammunition by a long shot. And what he's referencing is the ability of the Federal Reserve to intervene in the market. And he's reiterating that there was, quote unquote, no limit to what the Fed can do to lend money to financial markets. So there's a lot we can do, said Powell, to support the economy. And we are committed to do everything we can as long as we need to do. So it was not just the vaccine news on Monday that caused the market to rally. This interview on Sunday was certainly a catalyst. We used to call the Greenspan put, because Greenspan would always respond to the market on deep sell-offs. So there seemed to be a floor. We think this is a great example of one of those Fed puts that's here. Now, Treasury Mnuchin, I always want to say Nucci, and again, I don't know why. Noki, yes, I'm sorry. I prefer the pasta. During a recent video conference with the Senate, he was actually defending the current administration's execution of the stimulus plan. There's been some hiccups, and he stated the recovery may take some time to gather momentum, and the passage of time can turn liquidity problems into solvency problems. So what does he mean by that? He means that the 2008 was a liquidity and solvency problem because people couldn't get cash. And he followed that up with additional fiscal support could be costly, but worth it if it helps to avoid long-term economic damage and leave us with a stronger recovery. So any sharp decline in the market will be met with additional stimulus, despite, as we looked at that previous chart, the significant amount of stimulus that's already been injected. One of the things that was said after 2008, probably the most hated bull market and longest bull market, was that bad news is good news for the market. And I think that saying fits here as well, Mark, so far. So John, we're getting into that question and answer time. I want to turn it back over to you.
Well, let's go right into the thing about the S&P 500, because that's an interesting comment that you made, that now most people, I believe, think about the S&P 500 as the 500 largest U.S. companies. Mm-hmm. But in fact, that's not the case.
Right.
There's some type of screening process. And then now they're going to decide who's going to be in and who's going to be out. So first of all, who makes those decisions? And then how does that change actually happen?
Well, there's a lot of criteria, but it's a committee that's assembled to make those decisions. And we've just covered a couple of them: market capitalization, quality earnings, but they also are going to look at that sector. And the S&P 500 has done very well, especially compared to other indexes, because of that technology weighting. But I'm sure as an index that's followed by many as a diversified account, they are struggling and will have to make a decision on whether they continue to add to this technology as a committee. And once again, those top 10 stocks, if they would have limited half of them, you would have noticed that it wouldn't have been insignificant on return over the last 5 to 10 years. A lot of that return has been driven by a few names in the index.
Well, let's talk about two questions that come to mind. One is, if the knowledge of how that change is going to, or who the changes are going to be within the index, there's an issue in the investment world called front running. Can you talk about that? And then the other question is, what are the tax consequences to these types of changes when mutual funds and ETFs start buying and selling stocks to get back to mirror their index?
Right. So when an index is constructed, it's more as benchmark performance. It's not necessarily built to be a product or an investment vehicle. So the announcement, and also a lot of them are formulaic, you kind of know what names are going to go out. So Harley Davidson is probably not going to make it in the S&P 500. Let's say Zoom is going in. And that's going to be known beforehand, before the actual reconstitution of those names. So there are going to be a lot of people that know, well, there's going to be a large volume of shares sold of Harley Davidson and a large volume of shares bought of Zoom, just because of how much money follows these indexes. And people will sell Harley Davidson before and buy Zoom with the knowledge that one's going to depreciate because of the lack of volume and demand, and the other one's going to gain. So that certainly happens in these indexes. There are hedge funds that really focus on the Russell 1000 and 2000, towards the bottom of that 1000 list and towards the top of the 2000 list, and they're able to kind of clip some coupons with very low risk by doing that. So that is one of the components that's in there. Now, the indexes tend to be low cost, so you get some pros on the other side too. Now, regarding the tax, a lot of the ETFs that track it have sophisticated ways of making exchanges that don't cause a tax liability or a tax distribution out of the ETF. It's just kind of the nature of how they trade, as well as Vanguard on some mutual funds has a proprietary way of doing that. So mutual funds can do it as well. But it's not without a free lunch. There is changes in basis, and at some point it could be that you would realize a lot more tax liability because of these tax efficiency filters. If that fund was actually to start decreasing in size, maybe a movement away from the quote unquote passive strategies or these indexes back towards active managed funds, where assets were starting to come out of these funds, that could actually cause a tax liability to show back up.
So we have another question here. It says the S&P was down 34% at its worst, and now it's up 33% since then. Where do you think it will go from here, back to all-time highs? And let me add to that. If you remember a few broadcasts ago, you gave 2,700 as a fair value for the S&P. Now, at that time we were down, but we've now exceeded that, and we're within that trading range of that 2,950 that you were talking about. Can you comment on that and help to answer this question here?
Yes, I can. So the question there, because you threw two at me, was
I'm trying to tricky, you say.
Where the S&P is down 34, it's now up 33. Where do we see it? Well, it's over time, the markets move up, and we think that's going to be the case. The amount of money that's been created, we think, is a lot of fuel that has not yet been ignited in the market. Remember, a lot of the economic activity has been restricted. So there's a lot. The savings rate actually is up significantly. So that's a lot of dry powder still ready to go. And a lot of people are very skeptical of this rally because of the economic data. So I think the S&P will move up. Getting back to the constituents on Does the S&P committee increase the technology exposure, or do they start to look at the banking industry, the industrials, and try to get a more balanced, meaning similar market percentages or weights across those sectors? I think are all going to be factors on how the S&P 500 performs going forward. So we do think that it will move up. Now on the 2700, we don't think it's a coincidence that we've kind of been in a trading range around this 2950. We have 150 as a cautious earnings a couple of years out. We have a multiple somewhere between 18 and 21 for the S&P 500. And it seems the market is in agreement and it wants to see some of the uncertainty move out. Now, what is some of that uncertainty that can move out? Well, we get the virus. We already saw one day what that move could look, or the vaccine, not the virus, can look like. What's the demand, that pent up demand, look like as people get a little bit more comfortable with the economy being open? I passed Kohl's on the way to a person's house yesterday, and there were cars in the parking lot. That actually surprised me a little bit. So there's still a lot there, but I think it's just a matter of time before we start getting that certainty. And these numbers are certainly cautious. There's also the pricing in of a second wave that's still in the market that can be pulled out of there if that vaccine comes in. So long term, S&P should continue to move up, and we just got to get through this uncertainty here.
So we had another question. It says, what are the bearish indicators that you watch on a weekly basis? And what would cause you to change from your bullish outlook?
Well, I would say the money supply growth, if that's been the big thing for us on why we think the market is moving up. And if we were to start to see a slow in the money supply, that would be a big indicator. We look at breadth on just how stocks are trading. We're paying attention to the economic data. We want to see that it is moving up. If all of a sudden our relative strength, which is a slide that we did look at, that bonds and cash start to outperform some indexes on the short term, that would cause some pause. So those are the things that we're looking at on a daily basis.
Yeah. Well, let's switch to another question that we have, which is about the healthcare industry.
Yeah.
Especially hospitals. They said that hospitals have struggled since they were unable to provide the regular services for which they're paid to cover expenses. What is your outlook for hospitals and others in the healthcare industry? Will we see hospitals filing for bankruptcy?
Yeah, I think we will see some hospitals filing for bankruptcy. I think you can make a bear and bull argument here. One of the things that it is important to note is that the healthcare indexes, a lot of them are flat for the year, where the S&P is still down by 7-8% for the year. So the market is pricing in that the healthcare industry is going to do better than the general S&P 500 stocks as a comparison. But the hospitals have certainly, the bread and butter is the elective surgeries, right? And they have not been able to do those. And yes, there's some compensation for coronavirus deaths from Medicare, but it's nothing compared to what they were getting. And there are many companies or hospitals that are outside of those hotspots that have furloughed individuals. So there's significant trouble there, but that also means that people are not going into the hospital to get their cancer treated. New York, because of fear or assumed fear, of going into the hospital, has had a much higher rate of deaths due to heart attack at home because people are fearing to go in. So if all of a sudden the hospitals are able to open up and there's been a lack of medical screening over this time, I don't want to say fortunate, it could be a boom because that just seems like the wrong word for that, but there could be some pent up demand and a lot of elective surgeries coming online. So I think this is, and you talk about the word in Chinese for opportunity, right, has got danger and crisis has danger and opportunity in it, right? And I think that's a representative of hospitals. There are going to be some that are in dire straits. And those that remain and can make it through may actually have a lot of demand put on them.
So let's switch to real estate. We've had questions about real estate, and there's much speculation about the future real estate, especially in large cities like Manhattan. Los Angeles, San Francisco. In fact, Google just announced a work from anywhere policy, not just work from home, but work from anywhere, leaving the question around how much real estate will Google actually need or want going forward. Can you comment on this?
Yeah, it seems like a lot of people have an opinion on where the real estate is going to go, and we're no exception. We're a little divided. We were talking about it in the investment committee, and I think this is another one, a bearable argument, right? As everything, if it has a price, there's somebody that's bearish and somebody that's bullish. Otherwise, the price would have to change. So work from home experiment. Many people are touting that high productivity. I think it's a little too early to say that this has been very productive. We haven't gone months or years with this. There's companies have spent a lot of money on rental costs for good reason. There's company culture, there's supervision, there's training, there's just that socialness that that probably isn't going to be fulfilled at work from home all the time. I do think that flexibility to work from home is going to be there. But let's take our pandemic with the coronavirus. So if companies are still going to want to have that space because they find it valuable, but we do have these pandemics that are a risk and they need to have more space relative to employee, maybe that's actually a little bit bullish for commercial real estate. Now, the area that I think a bear argument is more convincing is the retail space, especially in malls that are not close to an interstate. They're going to struggle. I think the habits have really changed to these online, the pickup delivery. I was stopped in at Walmart the other day, and there was almost a whole row for pickup delivery. So people are utilizing it and preparing. So there are changes. I would not say that these buildings are just going to be sitting there vacant. They're going to be rented out. It's just at what price? What's the demand? It's complex. There's a lot here.
Yeah. So let's talk about another area in which we've had questions, and that is education. Mm-hmm. So last week, Harvard announced it's not opening its campus to students for the fall, yet Notre Dame is. Mm-hmm. In fact, they're going to bring students back 2 weeks early just to get them ready for how to be social distance and be safe. But many universities are still deciding how to proceed. And regardless, colleges have also been hit hard financially because of COVID-19, and most don't have large endowments to support them. So can you comment on the economic impact to educational institutions, and how do you see them reacting or changing for this?
Well, it's certainly, there's examples of very heated debates towards the end of the semester. There were universities that were doing classes online that the students didn't feel was really as valuable before, and they were asking for their money back. And there was a lot of animosity going back and forth between the administrators and the students. And there's been a lot of concern with the cost of education and how they compete. And they really have competed as more an experience than it is necessarily academic rigor or building around that academic rigor. And if you can't go to the campus and you can't have that dorm life, you can't have the buildings that they've been putting in for all the extracurricular activities, but you're going to keep a very high sticker price. I think that that's going to cause these universities to have to adapt and change their model if they're not going to be providing that campus, because that's one of the things people are doing, right? If you are going to tour with your children, you're going to go to the campus because it's really more about that campus than it is the educational experience, at least from the kids' mindset or the student. I shouldn't call them kids. So I think there's going to be a change in the way education is brought, especially if it stays online. And the current universities are really not equipped to deal with a shift towards online, where it's all about the professor and the academic rigor, and there isn't that experience component that they could sell at that point.
Well, I think that one of the things that's going to be interesting to see is, just like with hospitals, will there be bankruptcies? And the reason I'm thinking about that is, if you look at most universities over the last 20 years, they have spent billions of dollars in just building up infrastructure on campus buildings so that they could provide that experience. And one of the things I've often said is that it's easy to obtain, hard to maintain. So you can obtain the funds to go ahead and build a building, but when you have these large corporate infrastructures on these college campuses, that's going to be very expensive for them to maintain. And I'm wondering whether this may ultimately lead to either mergers of institutions or even bankruptcies. What are your thoughts there?
Probably a restructuring for sure. If they are really heading into these headwinds, you would expect some universities to close. A lot of the growth and costs in universities have been in administration. If it's really more about online learning, and you probably don't need as much administration in there. So it's like I said, it's going to change if this trend continues.
So I was speaking with an executive at a large national medical recruiting firm, and we were talking about the sentiment of doctors out there, because they talk with doctors all day long. And what was interesting is they said, do you know what the predominant theme is that they hear from doctors? It is that the predominant theme is that this virus is going to be with us until we reach herd immunity. So then I'm thinking that certainly gives the potential for a resurgence or a second wave, but in essence, this virus is going to be here until we get all the way through our global system. Do you think that the market has actually priced that in?
I do think it's priced in for the statement on the vaccine, right? What would the vaccine do? It would prevent that second wave. And based on that news, the market's rallying. That means that it's already being underpriced relative to that risk. But the doctors are correct. That's actually been the message. If you remember early on, they talked about flattening the curve. At no point was the argument made that we could prevent the population from getting the virus. It's always been said that you would have to get herd immunity. It was the pace at which the virus spread so that we didn't overwhelm the hospital system and not have enough ventilators and other things. So that's always been the case, that the virus has to run its course, absent a vaccine, which is just another way of speeding up that course, because you can inject a dead virus into people and they would have the antibodies. The doctors are just repeating what the strategy has always been.
So one of our listeners, who's a former public company CEO, commented that forecasting will be even more difficult since any resurgence of the virus will likely be of a regional nature. Forecasting. I never knew that to be easy. Was that easy before?
It's never been easy.
I'm not sure what you guys do there in the money lab or the
we read tea leaves, entrails, some crystal ball action. It's definitely difficult.
But he says that what will most likely happen, according to our listener, is we will see fired up hotspots and face local industry stoppages as they occur, which could ultimately impact supply chains in certain industries, making it impossible to predict until they actually happen. So would you care to comment on that?
I don't disagree. One of the things that come to my mind, though, is on the hotspots, and there's just so much to learn about this virus still. Why is it that the hotspots in New York and in Italy and France, they all seem to be or Asia, high population density areas with public transportation? Why hasn't the states, remember they were fearing this a couple of weeks ago, and they had to say, oh, just wait 10 days, just wait 10 days. And New York will no longer be the hotspot. Each city will be a hotspot. And that didn't happen. Is there something unique about the areas that have been the hotspot? Is it how urban and how dense they are? Is it the public transportation? Is it the climate? that wouldn't be replicated elsewhere. And I think there's a case to be said there, but the virus is going to be with us. So I still think it's a valid concern, and that we'll probably see some hot spots pop up here and there. And the supply chains is certainly an issue. That's one of the reasons that we're very bullish on the U.S. is all the offshoring. I mean, that's got to be the thing that most companies have learned, is how complex and how long these global supply chains are, and the need and desire to diversify where you're getting your product from, because we can't do anything. We can't make this risk go away. All we can do is mitigate it, and that's going to be done through diversifying. But that comes at the expense of a global economy that won't be as productive, because you're going to have resources creating 2 or 3 different areas of manufacturing. And we think a lot of that manufacturing is going to come back to the U.S. because
would you believe that would then cause more inflation?
Yes, absolutely. That's one of the reasons we think inflation risk is high. If you have to have 2 or 3 factories just to alleviate the risk of running out of one source from a supplier, well, that's going to increase the cost of being able to produce that good, instead of having just one or 2 areas doing that. So yes, we'll be less productive if we're not producing as many goods, and we're producing more money that goes over that. You would expect to see some price inflation. So it's not without a cost, but we think the U.S. is going to benefit from that onshoring because of that supply chain risk. Whether it's a hotspot, so let's say it's not even a hotspot from the virus, there's going to be other disruptions to the supply chain. One of the things that the pharmaceutical company took notice, and we've mentioned on calls before, was that I think it was 98% of antibiotics are created in China for the U.S. medical facility. And they said how benevolent they are that they continue to keep those factories going. Well, there's got to be a warning to the CEOs of these companies that they need to figure out alternative ways of being able to get those medicines if China was to weaponize that, or even if it was just another component that took that supply source offline again.
Right, that would be a large risk if all of a sudden it was offline for any sustained period of time.
I don't think Six Sigma is going to be all the rage over the next decade.
So it looks like we're out of time, and gosh, so we have so many other questions that we would like to have answered, but we'll have to wait until next week.
Same bad channel, same bad time.
Exactly. But remember what I said at the beginning, fear does not stop us from dying, but it can stop us from living. And it is a fearful time, but we don't want to stop living, that's for sure. So do you know what this weekend is, by the way?
Saturday and Sunday?
It is, but it extends until Monday, which means it's Memorial Day. So it's certainly a day that many small businesses are looking forward to and hoping that people start coming back. Yeah. And I do hope that this is a catalyst for them, because many of them have been struggling. And in fact, I know that you took your family to a restaurant this weekend.
Yes,
how was that experience?
It was, so we were spread out. We were in St. Charles because they were open. It was great. It was really nice. The staff all had masks on. The patio was open, but there were a lot of empty tables because of just keeping people at safe distances. So we ended up being in the banquet room, but it was still a great experience. It was just, it felt a little normal, which has been, that felt good.
Yes. And I think that's what people are clamoring for right now, is just the feeling of normal. Mm-hmm. Which is an interesting thing.
Yes.
We want the new normal to be the old normal. So thanks again to our listeners today, hearing into our broadcast. And as always, if you have any questions, please contact your lead advisor or any member of your team or our firm here. We are here for you. So long for now. Enjoy your Memorial Day weekend, and we will be back with you again next Wednesday.